joint stock companies, S.p.A., and limited partnerships, Società in Comandita per Azioni, represent fundamental legal forms in the Italian corporate landscape. They are classified as capital companies and are distinguished by specific structural and functional characteristics. Understanding them is essential for those working in commercial law and economics. These types of companies are primarily used to manage large scale economic activities. Their structure is designed to manage large amounts of capital and operate in complex environments, both nationally and internationally. They are the preferred choice for businesses with growth ambitions and significant financing requirements. A distinctive and fundamental characteristic of joint stock companies is the clear separation between share capital and the personal liability of shareholders. This principle forms the basis of their attractiveness to investors. The company acts as an autonomous legal entity separate from the individuals who comprise it. Consequently, the liability of shareholders is limited exclusively to the shares subscribed. This means that the shareholders' personal assets cannot be used to cover the company's debts or obligations. This risk limitation is a key factor encouraging investment and participation in the company's capital. The joint stock company Società per Azioni is the most widespread and recognized corporate form among Italian corporations. Its structure is robust and well defined, suitable for businesses of all sizes and sectors, particularly those requiring a large capital base. It is the reference model for large companies and those listed on the stock exchange. Incorporating a joint stock company, S.p.A., requires the drafting of articles of association, which must be executed by public deed. This fundamental document contains all the essential information about the company, including its bylaws, name, registered office, corporate purpose, and share capital. Its formality ensures transparency and legal certainty. Furthermore, the share capital must be fully subscribed by the founding members or other investors. At least 25% of the capital contributions must be paid in cash at the time of incorporation. This requirement ensures a minimum financial basis for starting operations. Finally, to acquire legal personality and operate legally, a joint stock company must be registered in the company's register. This registration makes the company enforceable against third parties and completes the incorporation process. Without it, the company cannot be considered fully operational. The share capital of a joint stock company is divided into shares, which represent the smallest units of ownership. Each share has a nominal value and grants its holder a fraction of the company's ownership. This division facilitates the circulation and trading of shares. Shares represent participation in the company's capital and give members the status of shareholders. They certify ownership of a portion of the company and are the vehicle through which members exercise their rights. Their standardized nature makes them easily transferable. Shares grant shareholders specific property rights. These include the right to profits, in the form of dividends, and the right to a liquidation share in the event of the company's dissolution. These rights are proportional to the number and type of shares held. In addition to property rights, shares also grant shareholders administrative rights. The most important is the right to vote at shareholders' meetings, which allows shareholders to participate in the company's strategic decisions. Other rights include the right to consult and challenge resolutions. Contributions or contributions by shareholders to the share capital can be made in cash. This is the most common and direct form of contribution which guarantees immediate liquidity to the company. Payment is usually made into a restricted account until registration in the company register. Assets in kind, such as real estate, machinery, or patents, may also be contributed. These assets must be subject to a sworn appraisal drawn up by a court appointed expert. The appraisal ensures that the value attributed to the assets corresponds to their true market value. Finally, it is possible to contribute receivables provided they are certain and liquid. Again, a careful valuation is required to determine their true value. Contributions in kind and receivables are subject to more stringent rules to protect the integrity of the share capital. The share system allows the joint stock company to raise capital from a large number of investors, even small ones. The standardization and tradability of shares make investing accessible and attractive. This mechanism is essential for financing large projects. This ability to attract capital facilitates the company's growth and expansion. Joint stock companies can finance significant investments, acquisitions, or research and development projects. Flexibility in raising financial resources is a crucial competitive advantage. The governance of a joint stock company is crucial to its operation and efficiency. It concerns the company's management and control system, defining roles, responsibilities, and interactions between the various corporate bodies. Effective governance is synonymous with transparency and good management. In Italy, the law provides for three main governance systems for joint stock companies, offering flexibility in choosing the structure best suited to the company's needs. These models are the traditional system, the monistic system, and the dualistic system. Each system has different characteristics and implications. The traditional system is the most widespread and well known model. It provides for a board of directors elected by the shareholders' meeting, responsible for managing the company. This collegial body makes strategic and operational decisions. The Board of Statutory Auditors, which acts as a supervisory body, operates alongside the Board of Directors. Its task is to monitor compliance with the law and the bylaws, adherence to the principles of sound management, and the adequacy of the organizational structure. The shareholders' meeting is the main decision making body which decides on the most important matters of the company. It elects directors and auditors, approves the financial statements, and amends the bylaws. Its decisions are binding on the other bodies. The monistic system is characterized by the presence of a single board of directors. This body performs both management and control functions, integrating the two activities into a single structure. It is a model inspired by the Anglo-Saxon system. The board of directors appoints a management control committee within its ranks. This committee, composed of independent directors, is responsible for overseeing the adequacy of the internal control system and the correctness of management. The dualistic system provides a clear separation between management and control functions. It is composed of two distinct bodies, the management board and the supervisory board. This model is of German origin. The management board is responsible for the operational management of the company. Its members are appointed by the supervisory board and are responsible for implementing the company's strategies. They are accountable to the supervisory board for their activities. The Supervisory Board is responsible for overseeing the management of the Management Board. It elects and dismisses the members of the Management Board, approves the financial statements, and can exercise liability action. Its members are appointed by the shareholders' meeting. The shareholders' meeting is the main decision-making body of the joint stock company. It exercises voting rights based on the shares held, deciding on key matters such as approving the financial statements, appointing directors, and amending the bylaws. Its decisions express the company's will. The board of directors, or management board in the dualistic system, is responsible for the operational management of the company. It implements corporate strategies, makes day-to-day decisions, and represents the company to third parties. Its actions are crucial to the success of the company. The Board of Statutory Auditors, or Supervisory Board in the dualistic system, oversees the administration, accounting, and compliance with the law and the bylaws. Its task is to ensure transparency and correct management, protecting the interests of shareholders and third parties. It is a bulwark against irregularities. The limited partnership by shares, Società in Accomandita per Azioni or S.a.p.a, is a less common corporate form than the S.p.A, but no less relevant in specific contexts. Its complexity and unique features make it suitable for specific situations. It is a strategic choice for those seeking a balance between control and capital. It is a hybrid company combining elements of a joint stock company S.p.A with those of a limited partnership, Società in Accomandita Semplice or SAS. This fusion of characteristics makes it unique in the Italian corporate landscape. Its structure is designed to balance unlimited liability with capital raising. In a S.a.p.a, there are two distinct categories of partners, each with well-defined roles and responsibilities. This duality is its most striking characteristic and determines its functioning. The distinction between general partners and limited partners is fundamental. General partners are those who have unlimited and joint liability for the company's obligations. They are also the only ones who can assume management of the company serving as directors. Their liability is personal and not limited to the capital contributed. Limited partners, on the other hand, are liable only for the shares they subscribe for. They cannot assume management of the company, and their role is primarily that of investors. Their position is similar to that of shareholders in a joint stock company, with risk limited to the capital invested. The S.a.p.a offers considerable management flexibility, allowing the general partners to maintain firm control over the business. This structure is particularly advantageous for family businesses or those where the founders wish to retain strategic direction. Management is concentrated in a few hands. Furthermore, the S.a.p.a allows for attracting investment from limited partners while retaining management control with the general partners. This model allows for raising capital without diluting the decision-making power of the founding partners. It is an effective solution for managed growth.